Okay. We will be talking about the information risk, the capital, the venture capital, and going public. Um, Probably going public is not today, but eventually, when you do your business, the company goes large, or you want to evaluate somebody's going public, so you can do that accordingly. Now, the source of funding develops through different stages. Now, in the early stage, we spoke about it last time, is about the financing is the most difficult and costly to obtain because you don't have anything to present. So to get a financing for your idea, it would be very difficult and very costly to obtain. The seed of capital is usually a small amount that you need is a very small, and the startup finance pays for develop and selling initial determined feasibility. Now, developing the financing as work capital support your initial growth. In the third stage, where the company has a positive cash flow and use the fund for sales expansion, that's when you want to finance. So you have the early stage, you have the second stage, which is the developing financing. The third stage is the company when you start having cash flow and money coming in, but you want to expand your sales and you need more cash to do that. The fourth stage is the fund are used to go public or being purchased. So that's the stage where you start going public and you start collecting cash, selling shares, or your company is getting purchased, and the acquisition financing is used to acquire the going public or being financed. Now, there are three capital risk capital market that the finance growth. Now, the public equity market is available for high potential ventures. So public equities is usually mostly done through banks. They have separate equity funds, mutual funds, you heard of it, or they have an insurance company usually have also, a bag of funds. That's so they can invest into. But they do that for a high potential ventures. The ventures is capital market provides some first stage funding for a large venture. So if you're talking about a small business, mostly these insurance company would not be able to do that. The private equity market provides a capital for private ventures. So the market consists of individual, they call them angel investors. They're available online. You can find them. You can associate with them. I do have a group of angel investors, and there is a venture capital firms, and there is a private equity firms. There are three different types, and each one looks at your venture differently. They look similar, but there is extra things that they look at it. And we will talk about each one separately. This market is a group of, the angel investors is usually our or regular risk capital market. The market is a group of wealthy investors. They call them business angels who are looking for equity investment opportunities. They have money. They probably got the money from other businesses. And sometimes you see the shows. Trump was one of these shows there. So they see the business plan, the venture, and they say how much they're willing to invest in it. So angel money available for investment each year is around $20 billion worldwide. I mean, in USA, only in USA you find around $20 billion available funds, which is they're willing to invest. So you need to dig in to find out these, who is the angel investors. Informal investors tend to be well educated, so they tend to invest in the firm where geographically close to them. So they are if they're Canadian, they will be investing in Canada with the people who and if they're American, will be investing in America or probably as far as geographically near to them. They make 1 or 2 deals a year, an average of 300 to 40,000, and they may join with other angels to finance a large. So if you have something called $4 or $5 million, they might call up on other angel investors to
Sir,
invest.
I'm not getting, sir, this point.
Okay, see.
Sir, related with a crude example.
Let me give you an example. See,
okay, sir.
We're talking different investors. There is
Like what, sir?
We are talking about different type of investors.
Yeah.
People who's going to put your money in and make you work your business and make money that you will have a revenue where you are generating revenue for yourself and for the people who's putting their money in. Now, there are different type of people. One type is called angel investors. The angel investors is called who have angel money. These people got their money from maybe their father died and their father was a billionaire, so they have money, but they don't want to get into business. They want to invest in others. Maybe they have money from their businesses, but they don't want to put it in the bank because bank is not generating enough funds, enough revenue. They give them 2%. So they are looking for people who wants to establish a business, and they will lend this money to these people to establish their businesses, and in return they will ask for a share or a percentage or a payback. So they call them an angel investors.
Sir, get it, sir, get it. Thank you, sir.
No problem.
Thank you so much, sir.
They are available in the market. You can find them online. You can meet with them, and you can present your idea to them. If they like your idea, they will invest in your idea, and
Got
they
it,
will,
sir.
and they call it.
Thank you, sir, so much. Thank you.
No problem. So the situation will be like that they have a tendency of, for example, they are tend to invest in the firm that's close to them. So you cannot speak to an angel investor in China and convince him to do business. It's not easy to convince him to do business in Canada because he has no control over it. So, but the angel investors in Canada or USA, they were probably willing to listen to you. An average of that, they would probably put, as the calculation study shows, they make $340,000 an investment in 1 or 2 deals a year. They're available in the market. So if you search on survey and the website, you might find a few groups or a few people who they are angel investors. And they may join with other angels to finance. So if you are asking for more than what they have or they're willing to invest, they might talk to their colleagues to come and start. And you probably, there is a Canadian show, you can see it. There is an American old show. They are considered to be an angel investor. Where do the angel investors find their deals? Deals are found through business associates, through friend, personal search. As I said, you can do business search, investment bankers. The bankers will use these angel investors comes in, and because the bankers aware of the community, the bankers will advise these investment angels to invest in these businesses. And from the business brokers, people who is there to allocate funds for you, they do know these investors. Angel network are a group of angel organized into a network or fund, and a growing and a common way to find a deal. So if you're looking for a cash or looking for resource, the angels are willing to do that, but in the same time, they have their condition, and they're very informative on things that they're going to work with it. Organized angel investment group are spreading in US. There were groups in US. There's also in Canada. You find them in UAE, in Dubai. You find them probably in Kuwait, usually in a wealthy society. People who have money, and their business is putting money and to get money back. The network or fund meet about usually 6 to 10 times a year, where they select an entrepreneur, may present their business idea. Lots of business people, entrepreneurs, trying to find these groups to support their entrepreneurship. But keep in mind, they will be very cautious to spend in you unless you have a good business plan and you take into consideration all the information that I spoke about it earlier about, how this entrepreneur is putting also his funds, his background, his knowledge, all these things. So they're not there to just throw their money. They want some guarantees and warranties also for them. Now, a crowdfunding is a different way than angel. Crowdfunding is also an individual investment and can be used to pre-test a product or a service. So it happens especially you can relate in a small villages. For example, in our back home, one person goes, well, tells all the villagers, please put your limited money there and I will invest it for you. That's a crowdfunding that you get all people put their money in and you give them share if the business is booming. This brings together various individuals who committed their money, the money to a project or a company they support. So the reward-based crowdfunding is when the individual pledge money to a company developing a new technology, a new cultural art project, or a new a musical album or whatever. You want to open your business and you have a crowd and you tell them, well, they need to fund that. Lending a crowdfunding allow the borrowing companies to
Sir,
yes.
Sorry, sir. I doesn't get the first point. Reward based.
Okay. From the word itself.
Explain, sir. General language, sir.
Yeah. From the word itself.
In simple, sir, language, sir. I doesn't get this hard language, sir. It is very hard.
Okay.
Sir, sorry to disturb you.
Yeah, no problem.
Okay, sir.
I'm fine with it. See, it's called a crowdfunding. It's made the crowd. You fund a crowd people. Let's say you're trying to, for example, you're trying to borrow money, but you're trying to do a new business, which would be part of the technology or a new culture art project or some musical.
Sir, like just borrowing money from relatives.
No, that's a family funding.
From bank?
No, that's a bank lending.
From friends, sir?
Yes, that's called a crowd.
Yes,
yeah, a crowd people is people who, a group of people, say you are in a village. You want to open a store about the people will come in there, they will look at you have a business there. And the business is all about I get some background noises, so I need to mute some. It's about reward-based crowdfunding is when available individual, when individual wants to get some money from your neighborhood, collecting from the city itself, and they will be donating, not donating, giving you money, and this money, they will get something in return for it, like a share or something. So that's what you call, it's a very simple thing. If you think about it, sometimes there is a business starts in a small village, and the person who is going to start this business, he goes in that village, start collecting money from the people in that village, and says, okay, give me your money, and when my business booming, I will pay you back, something like that. So that's what you call a crowd funding. um, a crowdfunding has a different way of campaigning, because you're talking about regular people who they will put their small share of business, small share of money. Somebody put $1,000, somebody put $500, somebody says, I'm going to put $100. So that's where you collect all this money, and then you give them a promising note or a share in your business. You want to open a gas station in a village that no gas station beside it, and you don't have money. You go to that village and you say, well, let's put money together, and then I can get the money and open a gas station. And if this gas station make a business, I will distribute that money for you. So it's a total different campaign. Planning to develop a marketing campaign, execute the campaign, and provide excellent services. It's the crowdfunding campaign, determine the crowdfunding site you will use to raise the capital. So let's go back to opening a gas station. You probably want to open, having a place on the road where all the farmers pass by, and you stop them and you start talking to them, opening gas station, which is, we don't have a gas station. You can provide the video and start sending it to all the people around you who will be, it's emotionally appealing, will be coming and pledging in the money. It's a way of collecting money, which is it's another way of funding your venture. So we said, yeah. So the funding your ventures is has a different way of doing it, and one of them is you talk to the crowd, and there is maybe a company who is funding the whole crowd, or a crowd who's funding one individual.
Sachi.
Okay.
Yes,
Now,
sir.
venture capital is a broadly, venture capital is a professionally managed pool of equity capital. Now, when you do an insurance, when you work in an insurance company, you notice one thing. There is something called um, venture capital, and it's driven from your money that they collect from you for a life insurance, for example. And they say, well, there is two parts. Part of it is goes to your life insurance, and part that we will be taking this money and invest it for you. Now, where do they invest? They don't open their own businesses. What they do, they say, okay, we have all this pool of money, and we look for people who wants to open their business, people who wants to expand their business, people who wants to do this. And you go and talk to these insurance companies. They're also the bankers. They do have capital. So let's say I worked for 10 years as a carpenter. I have nothing to do in business of technology, but I want to invest in technology. I save money, and instead of I go and invest in the technology with my limited money. I put it in the investors, like the insurance companies, like the bankers, and they collect everybody's money, and they have a professional person who his job goes and start financing these businesses around under their certain condition for the return. So this pool of money is being collected from different people, and this pool of money is there to invest in the market for venture people or for the people who wants to do their businesses. Now, um, the pool is managed by general partner, the venture capital firm. It's an exchange of percentage that they gain to realize. So these investors, what they do usually, they don't talk about how you do your business. They talk about business terminologies, but it their manager, their head, is the one who is going to decide whether they're going to lend you the money or not. So their main goal is to make money out of the money they are lending to you, and they're not looking to be a partner with you in your work. So if you are trying to tell them, well, put your money and you will be my partner, they say, well, my business is making money out of my money, and I'm investing only money to get my money back and more. I'm not looking to work into your business of exporting goods or importing goods. I'm just looking how much you're going to make profit and how much of this profit is mine. So this is how they look at it. And this is what you call the pool, the equity pool, the wealth. And they have a different approach than when you do a marketing campaign for them, when you're trying to sell your venture to them. And then there is a venture capital, which is a long-term investment. And usually this goes for bigger companies um, who needs to expand to a different business, or they want to do, um, for example, a new product line, something like that. They are the longer term investors. Now, the venture capital takes equity participation, and the overview of a venture capital industry, it is that's what's in the States, but it's kind of applicable in Canada also. The role of venture capital becomes an industry, this is only historical, after the Second World War. It is a capital owners, money owners, land owner, it itself becomes an industry. And they will lend you money not for working with you, is just for lend you money for getting their money back and more. Um, you have different organization and they, work differently. We don't want to spend that much time on this. It's just a historical things that you can read it later on if you're interested in it. Now, um, the venture capital industry has not returned to the highest level investment. So they still, um, people start more people, more investors are putting their money there to invest. And last year, in year 2000, they reached of 1.105 billion dollars. And they have invested over $105 billion in almost 8,000 deals. So that's in USA. Imagine how much money there to tap in. But to tap in is you need to be very professional, very knowledgeable, aware of your the business to tap in these. In 2017, the three primary industry that invested in it, guess what? The first thing is the internet. And most of the investors, they see the internet and the product, softwares, are they are generating lots of money. So they are willing to invest that. Then comes the healthcare and then the business product. So these are the three things that are mostly invested. That doesn't mean they're not investing in service or some other thing, but these are the top three categories, which is probably the internet thing is the highest one. The largest amount raised was for the later stage finance 2000, but for the expand, this information that you can, review it later on. Basically, it tells you the historical and the amount of how much, there is a money in the market where people investing in a real business. The objective of the bottom line thing, the objective of a venture capital, somebody who is putting his money, firms, is to generate a long-term through debit and equity investment. So he's going to be an investor, but the objective for him is, are you making a profit? How fast are you making a profit? What's the percentage of your profit? How can I guarantee this? What is your guarantees? These were they looking for. The higher is the risk, the higher they will ask for equities and return. The lower is the risk, the faster they do, and the lower they will ask for it. So the return on investment criteria increase with the increased risk in early stage financing. So if in your early stage financing, people look at you that you're not there. We buying fish in the water, put it this way. And they see that there is a risk in it. So it's, first of all, it's very high risk for them. Second, they're not sure if they, are willing to do this investment. So you probably will have lots of doors closed on your face, but eventually one will be opening for you with their own conditions. But once the business starts moving and starts selling, there's something to show. So easier to get the investors coming in. So if you're thinking of investors to come in before you start the business, you need to put lots of work in setting up your venture plan, the business plan, the presentation, the credential, the people should believe in you in order to invest. There is collaterals, there is something that you're risking in it, all these things. So the venture capital does not seek the control of the company. They're not looking to tell you what you're supposed to do. They're looking to put their money and make money out of their money. But usually they want at least one seat on the board of direction, so they want to see how the business is going on and all these things. So the value of the capital process and the preliminary screening being with the receipts of the planning. So must have a clear mission of the objective. When you write a business plan, it has to have a clear objective thing. The executive summary as must have be there because these people would be usually busy. So to look deeper in your stuff, you need to have a very good executive summary to make sure they were willing to spend their time to read your business plan. The investor evaluate the business, determine the deal fit into their portfolio. So if they're just looking to invest into technology, they would not invest in something else because they understand better technology and they know the technology makes more money. There is investors who they are willing to invest only in the oil. There's investors who are willing to invest in the housing. They have different interests because they're a background. The second stage of the agreement is general terms. Once they are finding that your business is interesting, then they present their general terms. and you present your general return. The third stage is detailed review and due diligence. So they do their research about you, try to find out how credential is your thing, how many times did you fail, are you in debt, in your bankruptcy. They're all due diligence, that they do whatever they do to make you to feel secure about you, to feel positive about you. The longest stage lasting from 1 to 3 months. So they will ask you for a time, and they might take a 1 month to 3 months to just check the background. And the final stage, they might get the final approval include a comprehensive investment memorandum or a contract saying this is how we gonna invest in you, this is what we're expecting from you, this is according to your sales, this is what we need to make in order for us to invest. So it's a contract. Locating and approaching venture capitals. Only approach firms who may be interested in your opportunity. You never go and say publicly, oh, I need money to every capital. No, you need to find which venture has been, which firms has been invested in a businesses like yours before. And once you find out, you need to talk to them. So if somebody in the housing business and you talk about the technology, he might not, first of all, understand you. And even if he's understanding, he's not interested in investing in technology. So you want to make sure you do a prospective firm carefully, including regional and national venture, to see who is interested in your type of the venture. Then approach a venture capitalist, people who have the cash, in a professional business manner. And here where you do your professional business plan and you do a professional presentation and you answer them professionally and you show you are qualified to do the business. So you seek an introduction, you select the right venture, you bring only one or two members of management team, you speak to the management team and you develop a brief, well thought presentation. So if you're telling, if I'm an investor and you come and says, oh, I'm going to bring ice cream to Canada from China. Well, that's a weird thing. You have to convince me something that's close to my mind. If I'm working in the technology, first of all, I don't accept that. Even if I'm working in selling ice cream, why from China? So these are so many, you need to do the studies about the venture capitalist, a person who you're targeting, and you keep in mind you are selling him your idea. So if you're not selling well, he's not buying well, he's not going to buy. So there will be a favorable first meeting, may lead to additional meetings if they like you, and on-site meeting for a coffee or something like that if they find you interesting for them. And if they reject, selected then different firms. So you don't go widely with all the firms. You probably select certain firms and then you take it from there. Valuing your company. The fact that in evaluation of my company. Now, in the previous classes, we said that sometimes you overvalue yourself and your stuff, and the other side is undervalue your thing. And it happens with lots of things that you sell sometimes. You have a second-hand car and you overvalue your second-hand car and you ask too much money for it. The other side is saying, no, this car is not worth it. So he's undervalued this. So you need to look at the market value in order for you to give the right price for your car. Now, how do you do the factors in valuation in your venture, your business? Now, you need to know the nature and the history of the business. So what's the nature is technology. And technology is one of the highest revenue, profitable business in the world. The outlook of the economy in general, whether it's going to be booming or going through the slope. The book value, the net value of the company stocks, and the company overall financial company for condition, whether you have, yours on the other side, do they have money? Are they in debt? Are they stable? How long do they be in business? Who their partners? All these things you need to collect before you present. The future earning capacity, that's the most important factor. Who wants to see how much you're selling? Is this selling going to generate profit? How much is profit? The growth, the dividend paying capacity. Are you going to be able to pay me back when I'm putting my money? When are you going to be able to pay me back? So being able to pay, it's much better than actual payment, because being able to pay, I have one thing in my mind. I do have an exit strategy as an investor. Being able to pay means I can collect my money, so I feel very safe. You're telling me I'm going to pay you, and then comes the time you're not able, that's a different thing. So you need to show the profit level. So that profit level gives a sense for a capital investor to see whether he's going to invest in you or not. Because he's going to see you, are you able to pay him when he wants to, time comes in. Might not ask you for the money, but are you able to pay? Then an assessment of goodwill and another intangible in the 6 factors. Goodwill, there is 2 restaurant opens beside each other. One is no name, makes food like McDonald's, and there is a McDonald's beside it. The one beside it, which is McDonald's, they both make the same food, but the goodwill of McDonald's is very high. It's intangible. You cannot put money on it, but there is a trust in it. That's what you call a goodwill. But in this restaurant, although there is similar operation, there is not much trust in it. So people are not willing to put more money in because they don't trust it. That's what you call a goodwill. The 7th factor is assessing the previous sales of the equities, whether you've done your business, how the sales is happening, how good is done, how profitable. And the final factor is the market price of similar company equities. So all these factors, you need to present to the capital ventures. When we call capital, people who is willing to put their money. There is more factors, but these are most common factors that a venture, somebody who wants to put his money in, would look at these points. And then he evaluates your business. Now, this is probably the last slide, and then we will take a break. So there is calculation happening, and they will send their accountant to do these calculations, especially when a business is going on and you're looking for a capitalist to put their money. And things that they're looking at, ratios. So they will talk about liquidity ratios. They will talk about the activity ratios, the leverage ratios, and the profitabilities ratios. And these are a calculation that's a very straightforward, which is you can go through it and see it. The current ratio is a ratio that 2 to 1. So they look at your assets and how much your liabilities, and if it's a 2 to 1, so this is a favorable. It's a 3 to 1. They might say he's not doing enough business, so could we have a little bit negative in it? If it's 1 to 1, then it's going to be a very dangerous situation. So this is how the accountant would look at it. The chartered accounting, or the CMA, the person in charge of doing the management accounting. The second thing is looking at it's called asset test ratio, which is the favorable is 1-to-1. He's doing the current asset that you have minus the inventories divided on the liabilities. These are all the ratios that they will evaluate when they trying to go and do a business with you. The other thing is the average collection period. That are you collecting more than you're selling? Sometimes one of the reasons people go bankruptcy because they're not collecting enough. They have so much money in the market, but they're not collecting. So they get into debt and they start starting going bankruptcy. And inventory turnover, the high inventory turnover is favorable. It means that you are selling really well, you're doing just in time, so product comes in your inventory in warehouse, and right away you're selling it. So high turnover of inventories, it tells me that you are doing very well in your business. There is a debt ratio, how much your liabilities compared to the asset, and there is debt to equity ratio, which is total liability to the stockholder. How much you're borrowing to do their business. There is a people that you notice in the life, they go borrowing from X to pay Y and borrowing from D to pay Z. And their jobs is only covering their debts. It's not really doing the business. So the debt to equity ratio will realize whether you are doing well or not. And the
Sir, give
higher,
break time.
yeah, well, it's going to be a break up to the slide. And this is where you
The
will do that. Okay. So now it goes on, and these are different type: return on investment, net profit. These are ratios that they will be looking at it. Now we will be taking a break now. Once again, in the break, what I will do is we will be back at say 4:45. Okay, you have more than 10 minutes. You talk among yourself. Find out who's your group, who is belong to who, and start building your plan, please. I don't want to see any email saying, who am I belong to? I don't keep a record, so you please start communicating with each other, finding out to who is, and let's start finishing this chapter. Okay, so now the general valuation approach and just give me a second here. Okay, wonderful. Here is one thing that usually it's a different and exception, and it's how they evaluate your the internet company. Because most of us going to be involved, lots of us will be involved in the technology. The evaluation of process of the early stage internet company is different than the traditional valuation. It's more got to do with the technology. The qualitative portion of due diligence carries more weight than other evaluations. So they will look more about your understanding, your talent, your ability to develop such a businesses beside the business itself, your your knowledge of the technology. After analyzing the size, the market size, as a potential revenue of a company, the investor examined the management team. Here they look at the management team also. They see when they do the evaluation, then they check the management team whether they can develop. And this is where you find out lots of big IT companies. They're very easy for them to get people invest in them because they have a proved record. Through the technology firm may sell for tens of millions, it's uncommon. So lots of companies that in technology, and we saw lots of videos where these people started very small and suddenly, they grow very big in no time. And this is because you have an access to the whole market. It's much expansionable as a business when it comes to the internet, selling things online and or selling your softwares or doing a service online. These are businesses that are booming so quickly. The internet and the tech firms are changing how the companies usually are funded, and evaluating these a company is based on the talent and the growth. Excuse me. The need for the funding source include required rate of return. So we did this, we saw this calculation, how much they're gonna get, how much they're gonna get profit from if they invest in you, how long it's gonna take, how it's gonna be, is gonna be cash or in different forms, amount of how much they're gonna control this venture, are they gonna control it or no control, the perception of the risk involved in it. So they will see how much risk in it. From the entrepreneur side, the one who is seeking for this capital, he wants to, the degree and mechanism of control, how much he is going to control this, very important for him. And how much amount of financing he needed, and what's the objective of the firm. So from entrepreneur side has a different view. The only reason he's seeking, he would seek funds from the capital ventures is when he is really, wants to evaluate how much is given up in the control or how much needs money and what's the objective of that and the firm. Now, in this chapter, we will talk about from funding the venture to launching to growing and ending the new venture. There's lots of ventures in the market that they go bankruptcy or they lose and they stop it. Lots of, there was a guy a few days ago, he said, well, you see me, I'm very rich, but I tried tens of ventures and suddenly I got successful. So there is lots of failing in it, and it should not be something discouraging. But if you're doing a right business plan, if you're doing the right research, if you're doing the right approach, the chance of failing gets less and less and less. So in this chapter, what we're going to talk about, we will be where to look for a growth opportunity. A successful new venture provides an opportunity for the entrepreneur to grow their businesses. So they have a small business and they want to grow it, or they don't have a business, but they want to, this is where a success is happening, that you want to grow it. So in this chapter, we discuss where to look for a growth opportunity, how you're going to grow your opportunity, how you're going to venture your business, implication of when it's growth, what's going to happen to you? Are you ready for the growth? Lots of businesses, they're not ready for growth. The venture, the person who is doing the entrepreneur sometimes is not ready for the growth. So he keeps controlling of it, and business can grow easily if he delegates more. So these are the things that you need, and how to negotiate for these resources. And we spoke about the fact that a venture, an entrepreneur looks at not the resource in the hand, how much resource can have an access to it, how much is control. So the chapter 3, in chapter 3, we showed that the entrepreneur that entrepreneurial and organizational knowledge provide the opportunity for new entries. Um, Differentiate combination and a different level. These types of knowledge create a different growth, such as you need to, maybe sometimes you need to penetrate a market, you do a market development, you do a product development, and you probably have a diversification strategy, which is that's the least one. But as we said, you did, some of you guys where when they're doing their marketing plan, we're thinking of marketing penetration. Some of them they were thinking of developing their market, and it's not there and already, and no needs for it. So you're thinking of developing it. And there is a group who do a product development, and this is how it is done. Um, okay. Um, okay. If you have, if the students, if still not clear about this, please, I'm just gonna quickly repeat the whole issue of this uh, assignment. And if you're still not clear, just talk to me now, because there is no time to be confused. I don't have the, we don't have together, we don't have enough time. Now, I'm gonna put a stop now. You probably will be targeting um, a new demographic or a new geographic market or a new product. So you might be targeting new people or new areas, or you have a new product that you're gonna do it. Now, the product development strategies and the selling a new product to new customers is different than if you have already products available in the market and you just wanted to, as a new entry in that market, to do it. There are two different approach for the marketing campaign. Now, experience a particular customer is an important resource for coming up of a new products. See, I'm not, the whole issue, let me take the last 10 minutes to go again over the assignment and the test, and probably that makes you feel much better ready for the assignment.